This conference will now be recorded.
Good evening. I would like to welcome you to the First Advantage Real Estate Investing webinar with Paul Szabo. Tonight's presentation will be in listen-only mode, which means you will not be able to interact with the presenter verbally. Please keep yourself muted throughout the presentation, and if you have questions, please ask those through the chat feature. At the end of the session, we will open the floor for questions, and all of the questions and answers will be sent through the chat feature. Again, that's located at the bottom of your screen. Lastly, this webinar is being recorded and we will have it made available tomorrow on our website if you want to go back and rewatch it. And without further delay, I'd like to introduce Paul. Paul, are you ready?
Yes, ma'am, I am. Thank you.
You're welcome.
Everybody, I appreciate your time this evening spending with us here to talk about the basics for understanding how to secure financing for your investment properties. So let's go ahead and begin. First, I'd like to introduce, excuse me one second. Can't move this thing. There we go. First time webinar, guys. Thank you in advance for your understanding and patience. Here with you today is our commercial lending team. So myself, Paul Szabo, the commercial lending manager. We also have Stephanie Walter, who handles our credit analysis as well as our portfolio management. And then finally, Elizabeth Willard, who handles all of our departmental operations. So what are we going to talk about? We're going to talk about a couple of different areas, areas that are important to lenders when considering underwriting. They will encompass a few different areas, of course, which are important to us, but equally should be important to you, which is the rent roll and what property NOI is. We'll talk about those acronyms DSCR and GDSCR. We're going to touch a little bit upon the review of the owner or / guarantor. The underwriter will look at the personal financial statement, the liquidity of the guarantors, their personal returns, and if they happen to be affiliated with other businesses, we'll look at those related business tax returns, and finally, what's on your personal credit report. The second half will focus on the commercial mortgage itself. We'll talk, the differences between a commercial mortgage versus a consumer mortgage and which one might be right for you. We'll talk a little bit through terms and amortization schedules of a commercial mortgage, as well as touch on the ever popular topic, the rates. Finally, traditional loan to value requirements, appraisals, and closing costs. So let's go ahead and start hitting through them. All right, so what's important to us? Rent roll and property NOI. So what is exactly a rent roll? A rent roll is a detailed report about the property, tenant, and the rents. So this can be constructed for a single property or a portfolio of properties. So essentially, this report details what you would earn in rental income from your tenant, any associated monthly expenses, and they can traditionally be estimated. Those monthly expenses could be possibly your taxes or insurance that you pay, any landscaping, really any cost that is on you as the owner with regard to the rental property. It'll list traditionally the lease start date for your renter, also a lease termination date, and finally anything that is important to you, like say maybe they give you a deposit that you're holding. So this report or rent roll is ultimately going to show you what your NOI is, or your net operating income. So you'll show your gross rental income. You'll subtract all those related operational expenses that I just previously mentioned to get your net operating income, which is what's king. Everybody wants to have that positive cash flow. Otherwise, there's no real point in having an investment property. You need to get that net operating income to your pocket. So in conjunction with that, the net operating income, there are a couple ratios that are important to us as a lender when determining a rental property's ability to cover its debt service. So that is the debt service coverage ratio, DSCR. So by definition, it's a key ratio used by lenders to help determine the ability of an investment property to cover its debt obligations. So going back to touch upon the net operating income, that again is the cash flow generated from your property, taking out of the cost of expenses and then dividing it by the projected or proposed annual mortgage debt service. So in my example, let's say you have an annual gross rental income of $18,000. Any associated annual operating expenses with that particular property, let's just call that $5,000. So your net operating income that you earn from that property would be $13,000. Again, these are all annualized numbers. So you're coming to us as a lender to put a mortgage on that property. So based on just whatever the number is, our projected annual mortgage debt that we're looking at, it's going to cost $7,800 a year, right? So you take, for us, the lender will take your net operating income divided by that annual mortgage principal and interest to get a ratio of 1.67. So question then becomes, what does that mean? So in simplest terms, the best way I can explain that is for every dollar you spend, you earn $1.67. So from a lender's point of view, a minimum debt service coverage ratio standard is 1.25. So anytime you're above a 1.25, you're looking pretty good. So related to the debt service coverage ratio, because a lender, we're always looking for all facets of the borrower. So related to the debt service coverage ratio is the global debt service coverage ratio. So very much like the debt service coverage ratio, this is the same thing, except it looks on a global point of view. So you as the borrower, most of the time will have a 9-to-5 weekly, job that you have, and your investment properties or supplemental income that you have that you do outside of your normal workday. So you have a source of income stream outside of your rental property. So when we're looking at putting a mortgage on an investment property, yes, we want the property to be able to pay for its own mortgage. However, we understand that there may be times where you won't have a renter. So we need to understand, does the owner / guarantor have other sources of income that they can pull from to make that mortgage payment in the event that they temporarily don't have a renter? So in our example, the debt service, the global debt service, is simply total cash flow available divided by total annual debt service. This includes all debts, all cash. So for example, in my example, we have here annual income streams for you as a borrower. Let's just call it $50,000. This could be from your day job, any other income streams that are available to you. Your total annual debt service, to include everything, again, is $38,000. So simply put, divide those numbers by themselves to get a global debt service ratio of a 1.32. So again, in the event your property would be unable to provide the rental income, we see that you have the capability to cover that mortgage in the event that the mortgage is not being paid by the renter. All right, so the next area on the table after the debt service coverage ratios are reviewed, we want to look at the strength of the owners, or again, they're also called guarantors. All owners personally guarantee the debts of the business. So areas that the underwriter will look, they will look at what we call a personal financial statement. This is usually a 2-page document completed by the owner that you list on the first page, list like just the values of any assets that you might hold. It could be your real estate, cash available to you, personal property, retirement accounts, anything that fits that bill. And then on the other side, is the debts owed by you. And again, this is on a personal nature. This is not anything tied to your business. That would be what would be on your credit report: credit cards, mortgage, automobile loan, anything like that. And then the second page of the personal financial statement, we ask, or all lenders ask, for the details supporting those assets and debts. So, for example, you say you have $30,000 in currency in cash. On page 2, you would say where that is. You would say $10,000 is at Bank of America, and the rest is at SunTrust, just as an example. We also want to focus on the liquidity of the owners or guarantors. You know, again, it all goes back to the ability to repay the mortgage in the event that the property does not have a tenant. So we want to know how liquid the owner or guarantor is. Can they easily convert assets to cash? Those might simply be stocks or treasury bills, money markets, things of those nature. Again, they'll also look at the personal tax return. The underwriter wants to see your adjusted gross income, and this mostly will be attributed to your day job and any income derived from other investment properties and whatnot. They're going to look at, your tax payments, debt obligations. Again, that's what's on your credit report. Calculate out estimated living expenses, because we know that not all income we have is free to put on rental properties. We have to live, pay bills and eat. So taking all that to account, we like to determine what a person's excess personal income is. And then finally, conjunction to what I just said a second ago, if you happen to be an owner of another business or a partner in another business where you derive benefit from, we want to review all that. And again, this is from a global perspective. We want to review to see, hopefully, a positive net income in your businesses. And we're also looking for ways to help and boost income available to you. So there are paper moves on tax returns that, are wonderful for an accountant to help small business owners with, but we are able to add those things back, and those things might be depreciation, interest, or one-time capital expenditures. So let's just say, for example, you have a commercial property or whatever, you had to replace the roof. We know that's not going to happen every single year. So the underwriter will likely add back in as revenue for you from that one-time expense, because we know it's not going to be there again. And finally, we're going to look at personal credit reports. Just like any consumer mortgage or any auto loan or any type of loan, we're going to focus on, are there late payments, charge-offs, your utilization ratio, and credit score. And just for FYI, the utilization ratio, that's just the amount of credit available to you divided by what your balances are. So if you have $5,000 or $50,000 in credit available to you, the more of that available credit you use, it drops your credit score down. So that's what the utilization ratio is. And that's all for the specifics with regards to the financing of that we reviewed. But next, let's focus a little bit on the commercial mortgage. So consumer versus commercial, what should you choose? Well, the good news is, if it pertains to a residential property that you want to use as an investment, you have both choices. You can go consumer or you can go commercial. So what we're going to do now is talk about a little bit of the difference between the two. So with a consumer mortgage, this is residential properties only. No commercial properties can be in a consumer mortgage. It is reported to personal credit bureaus, so it will show up on your credit report. Max loan to value is 80%. So there will need to be a 20% cash injection with regard to taking a consumer mortgage on an investment property. The property can be owned by a business, so the ownership on the deed can be in a business name. However, there is a requirement that the mortgage must be in your personal name. You can get traditional consumer mortgage terms. So that means a 30-year fixed, 20-year fixed, whatever is appropriate for your particular situation. The downside is, of course, you can only have 10 properties in your personal name. So that's where it cuts off. So once you become a seasoned investor, you'll have to start going the commercial route no matter what, but we'll be ready for you. And regarding closing costs, they are traditionally about the same as commercial, so no real big change there. So talking a little bit about the commercial side, this can be for residential or commercial properties. We, have that flexibility. We do not report to personal credit bureaus, so any commercial mortgage that you purchase in the name of your business will not report on your personal credit. We also have a max loan to value of 80%, but to make a little caveat here, if the property is specific use, so if it's a restaurant, possibly a church, if it's specific use, then it's likely that you will have a lower maximum loan to value, 65, 75%. So that is something you want to kind of pay attention to if you decide to go that route. But again, we're kind of focused on residential, but if you're interested in commercial, by all means, reach out and I'll be happy to go in more detail about any of this. But the mortgage, in conjunction with consumer, the mortgage can be in a business name, but it also can be, and the mortgage can also be in the business name as well as ownership. And it depends on how it's structured. So an individual can own a commercial property, therefore the commercial mortgage also can be in the personal name. The big difference is you cannot get a traditional consumer mortgage term. We'll talk more about that in a second. And there is no limitation on how many properties that you can own, okay? So we're gonna talk a little bit now about traditional or typical commercial terms, amortization schedules. So as an investor on a commercial side, your standard term is going to be anywhere from 5, 7, or 10 years. Now, the amount of your mortgage request is going to reflect which one is going to be more appropriate, because the last thing we want to do is saddle you with a very long-term term for a property that is you're only financing, 50,000 or 100,000. Okay, so we'll be real focused on that for you. Standard amortization schedules are usually 20 years, but on occasion 25 years. This also is tied to the amount of the loan request. So typically larger loan requests usually garner higher, longer terms and longer amortization. And also it depends on what's important to you. If the smaller payment is what's most important, I get it. Cash flow is king. You're going to want to have the longest amortization that we have to offer, and we can comfortably do a 20-year on most mortgage request amounts. And the term will again be appropriate to the amount. So what does that actually mean? So if I give you a 5-year term, 20-year amortization mortgage on your investment property, that just simply means that the rate is fixed for 5 years, but your payment is based on if it was a 20-year mortgage. So that just means at the end of the 5 years, when the loan matures, we simply just refinance it. Or you can pay it off. It's up to you. Most people just simply refinance, possibly take cash out for additional investment properties. But that's level 2. We're on 101 today, but again, we can talk more after the fact through email and on down from there. So if your goal is not so much worried about cash flow, but you just want to get it over with, pay it off quicker, then we can shorten the amortization that can be more in tune with what your goal is. So the last bullet just kind of sums it all. We can be very creative on the commercial side and build a term and amortization that will reflect your needs. So your cash flow is where you want it to be, and your ultimate goals. So next, the big question is rates, right? What rate can I get? Well, it depends. I know that's not the answer you're looking for, but that's really the answer you go and get. Simply put, everything that I kind of previously spoke about, all the financial underwriting, the strength of the guarantor, the strength of the debt service of the property. All of that's going to kind of influence what ultimately the rate's going to be. So it's really, really hard to give somebody a 2-second answer for a very detailed question. But that being said, you're going to get a great rate from First Advantage. Okay, we take everything into consideration and we'll do the best we can for you. So how we base our rates is based off the Wall Street Journal prime rate. So right now that is currently 3.25. So we go up from there. And rates are really good right now. So if you are interested in looking into getting into real estate investing, now is a great time. Rates are going to be decent, I think, for the next foreseeable future. And houses are moving. So now's a good time to go. So another component of the appraisal or the commercial mortgage is the appraisal. If your property is a single family property, the good news is your appraisal is just like a normal home appraisal, as if you were buying a house for yourself. Appraisals can typically run around $500 and turnaround time of about 2 weeks. I think that's pretty standard right now. Moving on up the food chain, if you're getting more involved in multifamily properties or even moving up to commercial properties, again, that's 102, we're in 101 today. The complex or the appraisal process is more complex. There's more variables and factors involved for the appraiser. And as you can see right there, the cost goes up quite a bit. And again, it depends on the complexity of the property that ultimately will decide what the cost will be. And they can take a bit longer than a normal residential appraiser. The other part that people are interested in and what you need to think about is the closing costs involved. This is something that you need to factor into your budget when trying to determine what you can afford for your first investment property. Closing costs are primarily passed through. There's not anything other than our origination that we hold, and they can vary dependent on the closing agent, by the amount of the loan, and like a normal mortgage, your closing will happen with either a closing agent or an attorney, and it can be. We have a whole slew of agents and attorneys that we can recommend, but if you have your own closing agent or own attorney that you prefer to work with, we're more than happy to work directly with them on helping you with your mortgage. So again, 2 biggest factors affecting these costs from the title agent or attorney are the title fees involved and any recording and taxes. That's not, unfortunately, really anything I can know ahead of the game, but depending on the amount of the loan request, we can kind of get in the ballpark and give you an idea of what you're looking at. But the rule of thumb is the larger the loan, the higher the closing costs are going to be. I hope I didn't run through that too fast, guys. I know it's kind of a lot to digest, but again, I'm happy to, if you have specific questions about a particular property or your specific need, I'm more than happy to talk one-on-one with you about those options and maybe give you some advice. So with that, I'll open it up and see if there's any questions out there.
So Paul, it does look like we've had 2 come in through the chat.
All right, great.
The first one is, what is the minimum GDSCR?
Okay, all right. Well, I would just say it's the same as the debt service coverage ratio. So if you're at our standard minimum is 1.25, I would say that's the standard minimum also for the global debt service coverage ratio. Good question. Looks like we have one in from Jane. Are commercial loan closing costs more or same as consumer? It's roughly about the same, but talking about now let me back up, Jane. If we're talking about a residential investment property, it's roughly about the same. But you start getting into, you know, large commercial properties, it can increase primarily because of the appraisal involved. Good question. Travis asks, are HELOCs available for investment properties? The short answer is no. Not from our side, but we can do HELOCs for small amounts on investment properties on the consumer side. So if you want to shoot me your information to my email, I'll be happy to get you connected with somebody on that. Stephen, what are the credit score requirements? Well, like any loan, we kind of want the credit score to be where it needs to be. However, you know, we take into account what's on the credit score. So we like the credit scores to be higher, but if there's mitigating factors to why a credit score is lower, we certainly will take that into account and look through that. So that's, if your credit score is not overly high, I wouldn't say you're out of the running. It's just something we have to look at it on a case by case, Steve. All right, Vazu, can I move a property to LLC after buying it in my personal name? The answer is yes, you can. We would treat that like a refinance. So during that refinance, we would just have it deeded in your LLC, and we would use your LLC as the borrowing entity with you being the personal guarantor. All right, let's see. Kevin, can you use these loans for flips or only long-term investments? Glad you brought that up. That is something I wanted to touch on that I forgot to, and I appreciate that. Flips can be used for this. Now, when we are taking into account doing a commercial loan for a flip, we go by, it's 80% loan to value, still our max loan to value in question. But we go by acquisition costs and also if you're working with a general contractor, you have a renovation budget in mind. We can take that in conjunction with the cost and get that to an appraiser for an after finished value for consideration of what we can do for you. So yes, short answer is yes, we can do that. If you wanted to reach out to me about that, there's my information. I'll be happy to talk to you in more detail about it. Johnny, do you service any other states than Virginia? I believe that's Maine, or yes. Short answer, from a commercial point of view, probably not, only because on the commercial side, we prefer our commercial investment properties to be in around our footprint. And so we don't tend to stray too far outside of that. So good question, but unfortunately, we have to stay in Virginia. So we have a question from Cherie. She says, can you apply for 2 loans at the same time, personal, resident, and investment? I think you could. You know, it would just be, you know, us on the commercial side would need to work very closely with the mortgage broker on your personal side to, you know, make sure you know, things worked smoothly. I would say it could be done. You know, so the short answer is yes, but I think we would have to talk through it to maybe make sure the logistics are going to be good and work appropriately for you. Tabitha, how do you go about getting pre-approved for multifamily homes? That's a great question. It's very, getting pre-approved for multifamily is really quite the same as getting approved for any investment property, residential or multifamily. We have a specific amount of documentation that we look for when we're trying to gather the financials that I'll get to our underwriter. But once we get that pre-approval, if you do not happen to have a multifamily property in mind yet, we can go from there. So yes, it's very similar process all the way around. And again, if you were interested in talking more about that, shoot me an email. We'll be happy to get more detail for you. All right, Mr. Tyler, if I just purchased a home in January, how long must I wait to purchase an investment property? Furthermore, how much money should I save for, let's say, a 120K mortgage? Those are great questions, Kashawn. Shoot me an email. We'll talk more specifically about your particular need. Thank you, sir. Johnny, Massachusetts. Sorry, buddy. We have to stick around Virginia. Travis, do you offer a portfolio loan for multiple properties? Yes, if you have multiple properties, we can consider putting a single mortgage on that. Stephanie, did you want to offer any advice on that one?
Hey, can you guys hear me?
Yes, we can hear you. Thank you.
Okay, great. So for portfolio loan, again, if you've got them, you own them, we were going to have appraisals performed on them. The has to cash flow, we're still looking at that 125 debt service and 125 global. And there's going to have to be appraisals on each and every one of those. Depending on the amount, will depend on, with the rate and the turnaround time, and obviously the number of properties on top of it. If it's a 10-fold portfolio, it's going to take longer for us to take a look at refinancing it. But excuse me, folks, allergy season. One thing you would want to also take into consideration on your side of things is what rate are you paying now versus what rate will you be getting? Because a lot of times it does not make sense to refinance. And you also got to look at your terms as well.
That's right. Yep. Great. Thank you so much, Steph. If you have any more questions about that, again, chat with us on the via email, and we can get you more assistance from that specifically to your need. Sean asked, can you own more than 10 residence properties as long as they're outside of the state? I don't think that has an effect on it. If you own the 10 resident properties in your personal name, or if the mortgage is in your personal name, excuse me, I think that just kind of cuts you off right there. After the 10th property, I know you have to go with a commercial mortgage after that. Let's see. All right, you're welcome, Sheree. All right. And Kari said, can I use my home as collateral to purchase an investment property? No. However, you can take out if you have equity in your home, I would highly recommend possibly getting a home equity line of credit on the consumer side, and then use those cash out funds to purchase an investment property, or use that as your 20% down. That would be the ticket. Steph, go ahead.
Stephanie again. I'm just going to throw a little caveat in there.
Sure.
The equity in the primary residence could actually be used as the down payment towards the purchase of the rental or investment property.
Very good. Very good. So I guess that is the good way to do it. You can. Both ways I think is appropriate, but Stephanie's our underwriter, and that's the easiest way. So follow her lead. Let's see, James. Mr. Credit score conversation, what's the ideal credit score? Okay, there is no real ideal credit score other than the higher the better. We take into account all factors that can influence one's personal credit score. We know that there are things that drive a score down that may have a very reasonable explanation as to why that's there and therefore driving the score down. So while we do take into account what's on your personal credit score or what's on your personal credit report, the score is just a starting point. It's just a number for us to look at while we analyze the credit report. So, a credit score is not going to get you out of the running. So if you are concerned about your credit score, I say, don't let that stop you. Just be prepared to explain circumstances maybe as to why your credit score is the way it is. Vasu, our commercial and consumer loan. Yes, ma'am.
Can I circle back around real quick to that?
Absolutely.
Okay, so we have folks that have 800 plus credit scores that are just loaded with debt, and they don't qualify for an investment property because their debt load is so high, even though their credit score is so good. And then we have people that have maybe a 650 credit score, and the only debt they have is the mortgage on their primary residence.
Right. Yeah.
And they will qualify. So the number is not the important part. We're not quantifying anything by a number. We're looking at everything as a whole.
Exactly. Well said. Well said. Vasu says, are commercial and consumer loans, do they have similar interest rates for the same property if I choose one over the other? So that is a good question. I would say typically mortgage rates are lower on the consumer side, but if it's an investment property, that will be a little higher than as if it was your primary mortgage. So the short answer is I would say we're probably pretty evenly matched when it comes to investment properties. So, if a consumer mortgage on your investment property is what's right for you, I would definitely explore that opportunity. Just keeping in mind those factors that it will be on your personal credit report. And you have to follow the consumer guidelines, whereas on commercial side, it won't be on your personal credit report. And but roughly I guess they're comparable right now. Very good question. You're welcome, Tabitha. Kevin, can you leverage equity from one property to cover down payment on another? We have done and do cash out refinances. But everything's situational, Kevin. We take those one at a time, and each particular borrower's situation is different than the other. Underwriters will analyze each person individually. So if your particular situation is right and it makes sense from us as a lender point of view, absolutely we will consider that. Jakarta, in order for current property to be under LLC, you have to refinance. Yes, if the current property is in your personal name and therefore probably the mortgage, I'm assuming, to put your property in an LLC with First Advantage, you will have to refinance because we need to put a commercial mortgage on the property. So yes. That's just speaking from First Advantage point of view.
I will just interject right there. If the mortgage is in the personal name, or the property is in the business name, or the property is also in the personal name, you can do a deed of gift from your personal name into the business name, but you've got to make sure you can do that without violating the terms of your contract with your lender for the due on sale clause.
Absolutely. Yep.
You can contact your lender and get permission. It's done every day. and they can say, yep, that's no problem. You're just changing the name on the property.
All right, let's see here. Jane, she says, is the 80% loan to value based on sale price or appraisal price? So it is based on sale price. Huh? What? Oh, or the appraised value, whichever's lower. Thank you, Liz. Wait a minute. I feel like I'm seeing repeat questions. Let's see. Hold on. James is asked with the ideal credit score. I think I answered your question, and there really is not an ideal, just higher the better. Can you refi non-warrantable condos? Stephanie, how does that look from an underwriting point of view?
I'm sorry, what was that? Non-warrantable?
Yeah, Travis asked, can you refi non-warrantable condos? Travis, maybe that might be something we can talk about after the webinar via email.
We have to do that because I'd have to do more research. Yes.
Thank you. Thank you. Let's see. Vasu, following up on Miss Stephanie's recommendation, can we also use equity on other rental properties as down payment toward purchasing an additional rental property? Steph, you want to hit that one?
You can, but I'm going to go back to what Paul said, that it is a case-by-case basis. We do not like to do cash out refis. So, you know, if the entire cash flow structure is solid and it's really strong, we will consider it, but we certainly don't like to do that.
All right, Tracy asks, what's the best way to pull cash equity out of my home? I recently did a straight refinance without pulling cash out. Should I refi again to cash out for down payment? I think that actually touches upon what Stephanie just said. Stephanie, want to bring that back up regards to using the equity as a down payment?
Okay, so read that question back to me again.
Yeah, Tracy had asked the best way to pull cash equity out of her home. She recently did a straight refinance without pulling cash out. And she was asking, should she refi again to cash out for the down payment? I was just circling back. You had mentioned that she, you can use the equity in your home as down payment.
You could do that. However, if you've got enough, if this is your personal residence, it would be best to actually go for a home equity line of credit. Your rates and terms are going to be a lot more favorable for you than to just do a straight cash out to use those monies as a down payment, where you can get a home equity line of credit at a better rate and accomplish the same thing.
Yeah. Thank you, Steph. Sean asked, does types of debts go into consideration, like a student loan versus like a mortgage when it comes to obtaining a loan? All of that is taken into account, Sean, when the underwriter looks at your personal financial statement and personal credit report. We don't ding a person because they have student loan debt versus mortgage debt. We look at the obligation of the borrower as consideration of the ability to repay the mortgage that they're applying for. All right, you're welcome, Jerkata. Or Jerkata. I hope I got that right. I apologize if I'm messing that up. Tabitha, what if you want to put your home in a land trust or at first, or is that something I need to have a one-on-one? Yes, very good question. And Tabitha, yes, one-on-one, please. Thank you so much. You're welcome, Jane. Thank you, James. Vasu, do you finance full purchase of condos which happen to be deeded as timeshare? We don't. I'll get Stephanie to join me on this one. We don't do any lending for timeshare properties. you know, if the condo is owned in your name, if you're the owner or your business name, we can therefore treat it like a traditional collateralized property loan. But that might be something we could talk more in detail about. But yeah, we don't do timeshares. Let's see. All right, Kashan says, what is the situation for two borrowers looking to buy homes together? What does this borrowing situation look like? Well, honestly, it's the same, except we look at two people versus one. And what that means is, Kashan, you'll fill out your information for us, and then your partner, I'm assuming partner in the business, will also fill out the same information for us. So the underwriter will look at both of you individually, and then look at the total situation together. Again, like we mentioned before about the debt service coverage ratio, the property in question is what is critical to, in our review, making sure the property can pay for the mortgage. However, in the global consideration, we'll look at both of you globally. So short answer, same process. We just do two people instead of one. You're welcome, Tracy. Guys, I think I got to my my last question. Unless there's anything else, I just want to say we appreciate your time. I appreciate all of you spending your last 45 minutes with us. First Advantage is here for you. We're always interested in helping our members and non-members who will become members grow their financial picture via real estate, or other ways. We have all kinds of commercial products and depository products, as well as consumer as well. So anyway, guys, I appreciate your time. Oh, I got one from Kevin. Can you pre-qualify? The answer is yes, you can. We just underwrite you without a specific property in mind, and we just qualify you up to a dollar amount, and then we have you go property hunting from there. Good question. Thank you guys. Again, I appreciate your time, and thanks for listening. It means a lot. Appreciate it.
All right, well, thank you everyone for attending tonight's webinar, and a big thanks to Paul and Stephanie for all the knowledge that they shared. As we mentioned in the beginning, this is being recorded, and so we will post this to firstadvantage.org/webinar, and you can go back and watch it. And then if you have any additional questions or want to talk with someone about the process, please be sure to reach out to Paul at his email address that you see on the screen, which is paulsabo@firstadvantage.org. Thanks again and have a great night.